Good morning, Armor Insiders. You're looking at a chart of junk bonds, and we're going to talk about that in a minute and how it affects the investing we're doing going forward. Before I jump in, allow me to say nice to be back. Been off the desk for a few days, took the family out to Steamboat Springs, did some snowboarding. I had a great time. Going to share with you today thoughts, big picture, macro, what happened with the Fed meeting yesterday and how it changes our portfolio. We're going to look at the 4 portfolios that we manage that make up this virtual hedge fund, from our carry trade yesterday, which was a classic. I mean, right out of the playbook play on Fed Day. In fact, our favorite with the highest probability of success, and it delivered again. So I'm going to walk you through that. We're going to talk about Armor Macro. The first thing we do when we get action like we had from the Fed yesterday is make sure we have all the exposure we want in the macro fund and the indexes. Next, we shift over to Armor Special Situations. That's where our individual stocks, those investments go. And we'll go over what are the stocks that are at the top of our whiteboard that we intend to be using to fill out that portfolio. We're already invested there, but we have some cash. We'll put some of that money to work over the next couple of days if the Fed Day rally holds. And then I'm just going to highlight one stock that may make it into our dividend portfolio. That's the 4th portfolio. So we have a lot to talk about. Let's dive in. Don't forget virtual hedge fund. What that means is I'm the chief investment officer. You're the portfolio manager of your own assets. So take what I talk about and any research you do, figure out your strategy, risk tolerance goals, and execute it. At the end of the day, you have to be the smart money. Nobody can do that for you. All right. So take what I talk about and any research you do, figure out your strategy, risk tolerance goals, and execute it. At the end of the day, you have to be the smart money. Nobody can do that for you. All right. So let's dive in. A quick review of the Fed comments yesterday, and it can be boiled down into this quote. I will read for you. I'll read it from Citigroup. All right. The Fed delivered a straightforwardly dovish message. Rate cuts are coming, even if inflation and growth run stronger than expected. That's it. We don't have to talk anymore about anything else the Fed had to say. That was the key takeaway. We heard it. We were live trading together. Everybody, all Armor Insiders had access to the live feed yesterday, so you could watch what we were doing and participate with us. And so literally when we heard that message, and the message I highlighted to you guys as it was happening, was Chairman Powell saying that he expected inflation to be higher in the first half of the year and lower in the second half of the year. So he's not too concerned that inflation was running a little bit higher. I mean, that was all we needed. I said to you guys when that happened, I said, guys, that's it. I mean, market's going higher. That's all it needed to hear. The chairman went on to say that in the back half of last year, when inflation was coming down more aggressively, the Fed didn't do anything. The Fed said, see, we didn't do anything then, and we're not going to get upset because inflation is a little bit higher now. We know it's going to be choppy. We expect it to be lower later in the year, 3 more rate cuts. We already are in a mechanical bull market, and the Fed just, boom, added some rocket fuel to it. So what do we do at the next stage here? The way we work on our trading desk, we use the S&P and triple the S&P for our carry trade. I'm going to go over that in a minute and how we made money again yesterday following the same play out of the playbook. All right. That's what's so much fun about the playbook. There's just so many different plays from the line of scrimmage. It's like a football game. And the faster the defense or the faster the offense sees, let's call it the offense, sees what defense is on the field, faster we can tear them apart. And yesterday was just a classic trade for us. So when we got that trade yesterday, we immediately shifted over to managing our macro fund by increasing the size of our index positions and adding this highlighted index. I'm going to highlight for you the index we added yesterday to the portfolio, and I'm going to give you a chart pattern of something which we just saw. You got a little peek that may be the ignition on this index. So the big question we've all been asking ourselves. So this is the highlighted stock of the day. It's an index ETF, and we're going to talk about how high yield junk bonds are perhaps the trigger that gets small caps going. We're all asking that question. I've just gone over a bunch of indexes with you. They look great. Where's small cap? Well, take a look at small caps. Look how far behind small caps are. That's what makes this so compelling. If there's a small cap trade before the end of this mechanical bull market, it's going to be big. Geez, man, small caps have to go up 20% just to make it to new all-time highs from here. That's how far behind small caps are. So it demands our attention because typically in a mechanical bull market, before it's over, there'll be a 3 to 6 month window where alpha shifts to small cap. This is why we keep hunting this down. We're using double or triple the small cap index. You can go double or triple small cap index. You don't have to pick small cap stock. Small caps just catch up with the rest of the market, 20% from here to make a new all-time high. You're looking at 40%, 60% gains in double or triple the index. So that's the focus in the macro fund. We added double right now. Double's enough for me. I'm using the doubles in the macro fund. Triples usually go in the special situations fund. And I may do that. I may add TNA to the special situations fund. I'm thinking about it. Okay. And here's the reason I'm thinking of being that aggressive. All right. First of all, when we talk about investing, it's a question of reward to risk. Is the reward there? Absolutely. If capital shifts, you'll get the big caps to continuing to move higher. Maybe they start to top. And when that's happening, small caps could light a fire on the small caps. I've seen it happen before. They go berserk for 3 to 6 months, which usually marks the end of the mechanical bull market. There's massive alpha there. Okay. So the reward's there. What's the risk? We're going to follow our stops. We got a new risk on entry point using the Armor algo yesterday. So we're on the position, hits the stop, we get out. We recognize that's the risk, but the risk is small compared to what the reward would be if capital really shifts. This is the highlighted chart of the day that suggests capital may begin shifting to small cap. Debt leads equity. Debt leads equity. Burn that into your brain. Debt leads equity. High yield debt, HYG is the ETF I'm looking at. You can look at junk, whatever. HYG I'm looking at, okay? High yield debt is the small cap equivalent in the debt market. Take a look going on. Look at where high yield debt is all the way down here, okay? Look at that. Look at the pennant formation coming in high yield debt that broke out yesterday. Now, of course, we need follow through. Of course, we need a weekly chart pattern that closes up here, okay? Weekly pattern. It doesn't get more obvious than that. Holy smokes, okay? Risk monitor turned green here, rallied up, consolidated the rest of the time. Now it's starting to break out. It's not that I want to buy high yield debt, although you could. Maybe I should. If that worked, I suspect small cap stock are going to hit the ignition button. And so that's where high yield debt pops up. You can make some good money there, right? And maybe you put that in like a dividend portfolio. What is a high yield debt portfolio? What is that? Let's see what that yields. 5.7%. I'm going to buy that in my dividend portfolio. I'm putting high yield debt into my dividend portfolio. I didn't even realize I was going to talk about that this morning. That just happened. That chart pattern at almost a 6% yield. Gee, that seems like a no-brainer to me. Okay. And that means to me that this new risk on entry point, the Armor algo, could be the beginning of the move for small caps that takes it out of that huge base and begins to close the gap with big cap brethren. Okay. So that's the highlighted group of the day, stock of the day, chart of the day, whatever you want to call it. High yield debt, small caps. 3 ways to engage with us. Armor report. You guys are watching this live right now. You're getting the captain's log. Go execute on your own. Armor insiders. You're watching this now. You're going to join me at 9:30 on the live feed. We're going to trade all day together and share information, whether it be trading or investing throughout the entire session, sometimes into the after hours when there's earnings now. And of course, if you can't trade, you got a job, you can't do it on your own. I get it. I'm here for you. If you need me to run capital, I'm happy to do it. You and I can talk about it, see if the relationship makes sense. Give me a shout, direct message, whatever, and we'll chat about it. Everybody have a wonderful trading session. Can't wait to see you guys on the desk at 9:30. And remember, at the end of the day, you can be the smart money. Okay.